A recent report from the Bank for Central Banks suggested huge changes have been quietly reshaping our financial system since 2008. This includes hundreds of trillions of dollars of debt being accumulated and global investors taking control of the financial system behind the scenes. That's why today we're going to unpack this report, explain why central banks are increasingly worried, and look at what role crypto could play. My name is Lewis, and this is a video you can't afford to miss. Now, the report that we'll be summarizing today is titled, quote, Financial Conditions in a Changing Global Financial System. It was published in June 2025 by none other than the Bank for International Settlements, or the BIS. The full report is well over 100 pages long, but to save you time and to preserve our collective sanity, we'll focus on just one key section and highlight the most important insights. First, though, a bit of background. For those unfamiliar, the BIS is essentially the Bank for Central Banks and is headquartered in Basel, Switzerland. Established way back in 1930, it's owned by its 63 central bank members, including heavyweights like the Federal Reserve, the European Central Bank, and the Bank of England. In short, this is the institution that calls the shots behind the scenes in the world of global finance, making it the ultimate financial puppet master. And as you won't be surprised to hear, the BIS hasn't exactly been crypto's biggest fan over the years. Back in 2017, when crypto was skyrocketing, the BIS quickly dismissed it as nothing more than a speculative bubble. Fast forward to 2022, amid the chaos of Terra, Celsius, and FTX, the BIS was practically celebrating, framing crypto as a volatile, dangerous threat to financial stability. No surprises there. Now, one of the BIS's biggest agendas is countering crypto with central bank digital currencies, or CBDCs. But interestingly, BIS wasn't always singing the praises of CBDCs. In fact, its current head, Augustin Carstens, initially said that there was, quote, no clear demand for them. But when crypto surged post-pandemic, the BIS suddenly did a U-turn, becoming one of the loudest advocates for CBDCs globally, to the extent that Augustin infamously admitted in a presentation that CBDCs would give central banks maximum control over currency. And central to their new CBDC push has been the BIS Innovation Hub, a kind of international think tank established to coordinate fintech innovation among central banks. It's responsible for a series of controversial projects like mBridge, which aims to streamline cross-border payments, and Project Nexus, which intends to create an internet-like network for instant payments between countries. Ironically, though, that is exactly what crypto already does. And speaking of irony, despite the BIS's critical stance, stablecoins and crypto continue to rapidly replace traditional financial channels, particularly for remittances and cross-border payments. Clearly, crypto is solving real-world problems much faster than any BIS-backed projects. But this begs the question, why should you even care about this BIS report, or really any BIS report for that matter? Well, because the BIS essentially writes the playbook that central banks follow. If you want to know what's coming down the financial pipeline, paying attention to the BIS is absolutely critical. And given crypto's growing threat to their traditional model, central bankers are undoubtedly planning their next move carefully. By the way, if you're enjoying this video so far, be sure to smash that like button to help give it a boost. And if you haven't already, subscribe to the channel and ping that notification bell so that you don't miss our next upload. Now, let's get into the report itself. The first section highlights some fundamental structural changes that have reshaped the global financial system since the Great Financial Crisis, or the GFC, of 2008. According to the report's authors, before the GFC, the global financial system was predominantly bank-driven, with banks primarily lending directly to private sector borrowers. Banks had household mortgages and corporate loans stacked sky high on their balance sheets. And we all remember how spectacularly that ended when the financial crisis actually struck. But since the GFC, the report highlights that banks' roles have significantly changed. Rather than lending primarily to private entities, banks have increasingly moved towards financing governments. The authors point out that sovereign bonds, which are debt securities issued by governments to finance their spending, have essentially replaced private credit as the main driver of credit growth worldwide. This shift was fueled by massive government borrowing to manage the aftermath of the GFC, and then later turbocharged by the pandemic-era fiscal expansions. The growth of these sovereign bond markets has outpaced traditional loans and corporate bonds by a wide margin. And according to the BIS authors, non-bank financial institutions, or NBFIs, have taken center stage in this transformation. These include asset managers, mutual funds, pension funds, insurance companies, and private credit funds, whose total assets surged from around 167% of global GDP in 2009 to a staggering 224% by 2023. The authors highlight that private credit funds, which are investment vehicles that lend directly to businesses, bypassing traditional banks, have also seen massive growth. To put this into perspective, private credit funds ballooned from just over 200 million in the early 2000s to over 2.5 trillion by 2024. According to the report, the structural shift has fundamentally changed how money flows internationally. Pre-GFC, cross-border capital flows were largely controlled by global banks. But now, internationally active asset managers have increasingly stepped up into this role, investing heavily in sovereign debt across multiple currencies and regions. The authors point out that this new model brings its own set of risks. The heavy concentration of sovereign bond holdings by global asset managers could trigger synchronized market turmoil if investor sentiment, suddenly shifts. To manage some of these risks, especially the currency risk involved in holding sovereign bonds denominated in foreign currencies, these asset managers heavily rely on currency hedging tools, primarily through instruments known as FX swaps. But more on that in a little bit. And as we've highlighted in our previous coverage of BIS reports, central banks appear to be deeply concerned about precisely these scenarios, particularly shifts that might cause investors to question the safety of the traditional instruments like sovereign bonds, pushing them towards alternative assets, possibly like crypto.
Hey, just wanted to give a quick friendly reminder about the Coin Bureau Deals page. It is your one-stop shop for massive sign-up bonuses on the top crypto exchanges. Also, you get huge discounts on trading fees and even exclusive deals on hardware wallets. Like always, there will be a link in the description below, so check it out. Now, back to the video.
Now, the second major topic covered by the BIS report is the explosive growth of the FX swap market. The FX swap market is one of those hidden parts of the financial system that doesn't often make headlines, but quietly plays a critical role behind the scenes. In simple terms, FX swaps are short-term agreements between two parties to exchange currencies today and then swap them back at a predetermined rate sometime in the future. This effectively allows investors to protect themselves from currency fluctuations, enabling them to safely invest across borders. Additionally, FX swaps make it easy to borrow and move currencies internationally, ensuring global liquidity and fungibility between different currencies. In fact, nearly 90% of all FX swaps involve the US dollar, which honestly, it puts a question to all the people calling for the imminent collapse of the dollar dominance. But you know what? I digress. The BIS, their authors, also revealed that the outstanding FX swap volume reached an eye-watering $111 trillion by the end of 2024. To put that into perspective, that's larger than the entire global GDP. Since 2009, transactions involving NBFIs have nearly tripled in size, surging over $50 trillion by 2024 and becoming a significant part of this enormous FX swap market. And here's where things start to get interesting. The BIS describes FX swaps as a type of collateralized borrowing. However, due to accounting conventions, these huge transactions are kept off of balance sheets, effectively hiding their size and potential risks. The BIS goes on to explain that FX swaps have essentially become the plumbing for the global financial markets, allowing money to seamlessly flow across borders, making currencies interchangeable and facilitating massive international investment flows. For instance, a European pension fund could easily borrow dollars through FX swaps to invest in US treasuries without facing currency risk directly. But here's the kicker. Most FX swaps have very short maturities, often less than 1 year. This short-term nature makes the entire market highly sensitive to rapid shifts in sentiment. If something spoofs investors, like a sudden spike in interest rates or unexpected geopolitical tensions, it could trigger a rapid unwinding of FX swaps, leading to significant market volatility. The BIS even highlights a real-world example from last year's yen carry trade episode. Investors massively borrowed yen due to Japan's ultra-low interest rates, and then they swapped it into higher-yielding assets elsewhere. But when the Bank of Japan raised the interest rates and issued surprisingly hawkish comments, these yen-funded positions quickly started to unwind, creating sharp volatility that temporarily tightened financial conditions globally, including in the US. And if you want to know how we could be on the brink of an Act 2 of the yen carry trade unwind, then check out our video on the topic right over here. Meanwhile, another eye-catching insight from the BIS report is how closely FX swap volumes track portfolio investment flows. For example, according to one of the graphs provided by the BIS, there's a clear correlation between FX swap activity and bond flows into the US, particularly when hedging costs are considered. Basically, when it becomes cheaper or more attractive to hedge, global investors move more capital into US bonds, easing the US financial conditions. But here's where crypto enters the picture. While FX swaps have become essential for traditional investors to manage currency risks and move funds globally within the legacy financial system, crypto, and specifically stablecoins, are quickly emerging as compelling alternatives. Stablecoins offer a simpler, faster, and often cheaper way to handle cross-border transactions, allowing users to bypass traditional banking channels entirely. This is particularly relevant in markets with limited access to traditional finance, offering an accessible alternative for moving value internationally. And if you watched our previous video on the BIS, you'll know that cross-border crypto flows peaked at around $2.6 trillion in 2021. Not too shabby. But, of course, the authors don't mention that. In short, the BIS is clearly concerned about how essential and simultaneously fragile the FX swap market has become. While these instruments have enhanced market efficiency and cross-border investments, they've also amplified short-term risks and the potential for sudden market reversals. And as we've seen before, central banks, they aren't exactly comfortable when financial systems evolve in ways that they can't fully control. Now, the final part of this BIS report dives into how all of these structural changes and the explosive growth in the FX swaps are impacting global financial conditions. First up, the report highlights how managing monetary policy has become significantly more complicated for central banks. Remember, monetary policy works primarily through interest rates, affecting how easy or expensive it is for businesses and households to borrow, invest, and ultimately fuel economic activity. But thanks to the structural shifts that we've just discussed, particularly the rise of global asset managers and the enormous growth of the FX swap market, central banks are now facing an unprecedented challenge. Financial conditions in one country are increasingly influenced by events unfolding in other major economies. A key takeaway from this report is that shocks, especially those driven by rapid changes in investor sentiment, are now rippling across borders faster and stronger than ever. So, a financial shock originating in Europe or Japan could swiftly impact conditions in the United States, and vice versa. To explain this further, the BIS identifies two primary factors driving the financial conditions worldwide. First is the so-called level factor, which essentially includes interest rates and yields on safe assets, such as government bonds. The second is what the BIS terms as the risk factor, which includes investor risk appetite, market sentiment, and valuations of riskier assets like equities and corporate bonds. Now, typically when central banks tighten monetary policy by raising the interest rates, investors become more cautious and risk appetite tends to drop. But as we've seen in recent years, the reality isn't always straightforward. When interest rates reached their multi-decade highs, markets initially plunged, but this changed when the rates hit their plateaus. Many economic analysts, they described this environment as the perfect storm for everything, from stocks to crypto, to get completely wrecked. They suggested that we were heading straight into a multi-year bear market. Yet, the exact opposite happened, with markets instead delivering surprisingly strong returns. Looking back, we could see that this unexpected resilience largely stemmed from massive deficit spending by governments around the world. This fiscal stimulus dampened the impacts of high interest rates and the quantitative tightening that central banks were doing. The BIS highlights how these conflicting influences have made financial conditions increasingly difficult for central banks to interpret and manage. Adding yet another layer of complexity, the report points to international asset managers, those influential NBFIs that we discussed earlier, as significant players amplifying cross-border financial dynamics. Because asset managers rapidly adjust their investment portfolios in response to shifting global risk perceptions, this creates heightened volatility and interconnectedness across the markets. In bullish periods, vast amounts of capital flow into riskier assets worldwide. But when market sentiment turns bearish, capital flows reverse just as quickly, heightening volatility. Another crucial dynamic highlighted by the BIS is the role of exchange rates, especially regarding emerging market currencies. Because emerging market borrowers frequently owe debt denominated in foreign currencies, particularly the US dollar, a sharp appreciation in the dollar can instantly tighten financial conditions in these markets. Essentially, it becomes more costly and challenging for borrowers to service their dollar-denominated debts, potentially triggering rapid financial stress and spillovers into the local markets. Some analysts even have speculated that this has been used as a sort of weapon by the US to exert financial pressure on foreign governments. But that is a rabbit hole for another time. The BIS also points out that advanced economies themselves are becoming increasingly sensitive to these currency-driven shifts. The enormous FX swap market we discussed earlier amplifies these effects by facilitating substantial cross-border bond investments. Therefore, when exchange rates move abruptly, financial spillovers can become particularly powerful and widespread. That being said, the authors highlight that central banks haven't lost all control yet. Despite these increasingly powerful global influences, domestic monetary policy still strongly influences global financial conditions, especially local bond yields. Nonetheless, the BIS acknowledges that global factors now frequently impact financial conditions more swiftly and forcefully, complicating timely central bank responses. In plain English, they may still retain control, but maintaining that control has become significantly harder. But before we wrap things up, there's still one critical question left unanswered, and that is, what does all of this mean for crypto? Well, first off, central banks are clearly feeling the pressure of an increasingly interconnected and complex financial system. As the BIS report reveals, these structural changes mean central banks no longer have complete control over financial conditions. They must constantly respond to global factors that shift rapidly, and as we've discussed, central banks seem to be increasingly concerned about losing control over currency flows, capital movements, and ultimately their ability to effectively manage monetary policy. This is probably why the BIS has frequently warned about crypto's role as an alternative to traditional financial channels, especially when those traditional channels falter or become less appealing. This latest BIS report only underscores these concerns. As financial conditions become more globally synchronized and markets become more volatile, the potential for traditional financial instability rises substantially. Investors, especially those in emerging markets facing volatile currencies and economic uncertainty, are increasingly looking for alternatives that offer more control, more reliability, and lower costs. And crypto seems perfectly positioned to meet this demand. Just look at stablecoins like USDT and USDC, which racked up a staggering $1.2 trillion in cross-border flows in 2021 alone. Now, it's worth remembering that the BIS authors previously warned how the rise of stablecoins and crypto poses a significant risk to central banks' monetary sovereignty. Crypto gives individuals and businesses the ability to move funds globally without intermediaries or central control, directly undermining the tools that central banks use to manage their economies. This makes it pretty clear why the BIS has been calling for stricter rules on crypto exchanges, stablecoin issuers, or even selective bans, because they are afraid of losing their grip on the global financial system. We've already seen regulatory crackdowns kick into gear in jurisdictions like the US under what's been dubbed Operation Choke Point 2.0, though thankfully that particular saga came to an end when Donald Trump returned to the White House. And central banks, driven by the BIS agenda, are going full steam ahead on their CBDC projects. As mentioned earlier, the BIS has placed CBDCs at the very top of its priority list, positioning them as the central bank's main strategy to directly counter crypto's growing influence. CBDCs give central banks the precise control over capital flows and financial conditions that traditional methods are now struggling to provide. However, despite their best efforts, intense public opposition has caused CBDC projects to fail outright in certain countries like Nigeria. Ironically, the more aggressively central banks push towards CBDCs or restrictive regulations, the more appealing crypto becomes, especially to those seeking financial freedom and privacy. As we have seen, global financial instability often accelerates crypto adoption, especially in regions where trust in traditional finance and currencies is already low. This doesn't mean smooth sailing, though. Far from it. Crypto's regulatory woes are likely far from over. Central banks will undoubtedly double down on their push for CBDCs, and traditional financial players won't go down without a fight. But the bottom line is that the current trajectory of global finance highlighted in this BIS report makes crypto's case stronger than ever. And if you want further assurance on how crypto is going mainstream, then check out our most recent video on the right over here. And if you haven't subscribed to the channel yet, you can do so right over there. Thank you so much for watching, and I'll see you again very soon. This is Lewis signing off.